Good morning, my name is Krzysztof Kwiecień, I'm Chief Economist of XTB and you're watching our weekly trading webinar. So today we are going to discuss central bank decisions that were taken last week and I think were a shock for many market participants. Even though a week ago I told you that the Fed is going to turn hawkish, many market participants didn't really believe, and even the instant reaction was somewhat misleading. However, the combination of many factors led to markets soaring definitely towards the end of the week, and today we have a continuation of this. So let's start with the quick overview of central banks' decision, starting from the Fed, going through ECB and Bank of England, and then let's move on to the screens and see how the markets have actually reacted to this. So let's start with the Fed and its hawkish turn. So of course, the Fed is still very accommodative. The interest rates are at 0% level, or it's 0 to 25% actually range, but they are very accommodative. They are still printing money. However, if you look at the outlook, it's changed because until the December meeting, the expectation was that the Fed would print till the middle of 2023 at least, and right now they doubled the taper pace and they are expecting to print until no longer than mid-March. So this is definitely a change, and as I was showing many times before, it will have an impact on market liquidity. Of course, there is still a lot of liquidity on the market, so right now you can see a move from equities to bonds because money need to go somewhere. However, with the Fed printing less and less and very soon printing not at all, and other central banks printing also less, as we will see in a second, there will be less money on the market. So obviously this will have very important ramifications. Secondly, as you can see here on the dots, central bank participants in the US, they expect very rapid, at least, you know, comparing to the recent years, pace of interest rate increase. As you can see here, for 2022, even the lower, let's say, cumulation of dots, which is where we believe Powell to be, assumes 2 interest rate hikes, and median assumes 3 interest rate hikes. And then 2023, even, you know, the Powell group, which is the yellow, highlighted by in yellow group of dots, even that assumes interest rates close to 1.5%, which is definitely a very significant increase from where we are now. And third, and definitely not least important, is that change of tone during the conference. So at the last conference in November, Powell was saying it's a time to taper, it's not time to talk about higher interest rates. Whereas right now, it wasn't only time to talk about higher interest rates, but it was also time to talk much tougher on inflation, admitting that maybe too much was done before to stimulate the economy, that demand is too strong, that there are issues, and the Fed could be forced to tighten even if there is lingering pandemic, because it could be pro-inflationary. So definitely a change in approach. And how this could impact markets? Well, here you can see on this chart many measures of valuation for S&P 500. And I think this chart is nice because it shows a stark contrast between many measures that are not related to the cost of money, which are either at historical highs or close to it, and only 3 measures that take into account level of interest rates. As you can see, they are below average. So what it means that if you take away cheap money, the S&P and all, in general equities in the US and globally, but especially in the US, they're extremely overvalued. So there is no point behind these valuations other than this monetary policy, which is why if you hear voices saying, look, well, in the past, markets also did well during the period of tightening, yes, but the starting point was definitely not like this one with such extreme valuations. So this is definitely something you want to have at the back of your head. And then third, which is also relevant globally and from the economic point of view, more than markets, but obviously it's all intertwined, is that, as you can see, the global economy has never been so much leverage as it's now. So for instance, if you look at the 70s, the period where interest rates were high because the Fed was fighting inflation, total debt to GDP was at around 100%, just slightly above this level. Right now we are close to 250%. So obviously there is so much more debt, and obviously we are not going anywhere to double-digit rates, but even smaller increases with this base of high debt, they will have significant impact on these effects of tightening. So I would say yes, this response was much later than it should be, but it doesn't mean that it's meaningless. I think it's more important than markets assume. Then the ECB, of course, the ECB they cannot even think about rising interest rate because the governments in certain Europe are indebted, and because with higher interest rates everything would collapse as it did 10 years ago. So I don't think ECB is going to consider higher interest rates. However, they still managed to produce some kind of hawkish surprise last Thursday by rising inflation forecast to 3.2% for next year, which is pretty significant. It's higher than the Fed's one, and suggesting that their printing programs will be tapered down very, very significantly already from the first quarter, but then second quarter it will go down very strongly. So of course with the Fed, if we assume they are going to indeed follow through with their plans and finish the bond buying program in March, then obviously with the ECB also printing much less, and with Bank of Japan already printing much less, we will have obviously far lower levels of this fuel that was behind these wild rallies on many markets, including equities, cryptos, commodities. So yes, like I said, the ECB is in no place to consider higher interest rate, but even with lower level of printing, it's still significant. And then with the Bank of England, also surprising move to increase interest rate in the face of Omicron in the UK to 0.25%. The move itself, of course, doesn't change all that much because obviously these rates are still very, very low historically. However, I think all the three, the Fed, ECB and the Bank of England, they signal the general change in approach, which is significant because if the change occurred early this year, probably wouldn't have such a high inflation now, and we wouldn't have so many market exuberances. So now with the change from central banks and investors assuming that would never happen, because I think there were many investors in the markets assuming, look, central banks will always support markets. So if they are consistent and if they really start fighting inflation, this could be very, very ugly surprise for markets in 2022. So let's take a look at the charts and let's see where we are with them. So of course, very important consequence is for Nasdaq 100, the market that benefited the most, because the companies which are there, they benefited from the pandemic, they benefited from restriction, from the overall change to technology, but of course also from very, very low interest rates. So right now we still have this upward trend here, which is, you know, if you look from the bottom of 2020, March 2020, it's extraordinary, the whole rally. And all the time where we were here, there was some kind of buying the dip, which is also very clear recently on this Omicron sell-off. Markets very quickly rebounded, and there is a temptation to buy the dip. And I think we can have it again because, you know, there are many retail investors who are new to the markets and who do not understand that there could be a crash or very severe bear market when the circumstances change, as they seem to be changing now. So I wouldn't be surprised to see another technical bump from here, because we have this ABC corrections, and and this wave C seems to be maturing here, and also the support is there. So why not to try and you know, buy the dip once more? So it is quite possible for the short term to see a kind of rebound here, especially on the S&P 500. We are also close to this level of support. So I think there will be attempt to buy the dip on the US markets. However, in the longer run, like I said, these circumstances, they seem to change quite a bit. So So it's possible that this, even if there is a rebound, even there is buy dip approach, we could very quickly see again a change sentiment to the negative one. For the DAX, also very significant sell-off at the beginning of this week, and it is here the market already looks different. As you can see on the Nasdaq, there was very consistent upwards, and whereas on the DAX there was very consistent, let's say, range between 14k 800 to 16k 300, and this zone especially, it saved the bull market on many occasions. And yeah, it will be also important to see if it acts like this again. However, the whole year, nearly the whole year, starting from April, it looks like a very vast distribution zone. So at the end of the day, this should also end with some kind of deeper market pullback. When we look at the currencies, the pound, it initially gained against the other currencies. However, these moves were somewhat moderate. So yes, it increases the odds of breakdown here on the euro pound to the lower levels, because this monetary policy in the UK, it already has started to become more restrictive, but yeah, the difference could start becoming greater if the Bank of England continues with interest rate increases. So yeah, so so this zone is still in play, 0.83.5, but yeah, so far we are above. So like I said, these moves on the FX markets, they are still relatively benign. Also, when we look at the euro dollar, we can see that yes, these moves are fairly moderate. Yeah, the downward trend for the euro dollar is there because the euro is the weakest. The ECB, like I said, no perspective for higher rates. So yeah, it is quite possible that this downward trend on the euro dollar is extended even further from where we are now. Okay, so finally, let's take a look at the gold market and if it could actually do well amid this environment of expected tightening. So as the reason we are discussing gold is because it rebounded quite strongly on the Fed. You can see this candle here, it was the day of the Fed. So initially gold prices went lower, but then rebounded very strongly and followed this with strong growth on Thursday. So there was a confirmation of this defense of this $1,765 support zone. At the same time, even stronger defense was in play on silver, 21.6, 21.5. This was the zone that has been defended, and therefore there is a hope on the markets that we could see a greater rebound on precious metals. So is this really the case? So if we look at the relationship for gold, it looks to be strong with 10-year bond yields, and luckily for gold, these yields actually have declined despite the hawkish tilt from central banks. This is because market participants, they expect some kind of slowdown in the global economy, and therefore we have a move from equities to bonds, and there is still a lot of money on the market. However, with tapering from both the Fed and ECB, we could have less money in 1 month, 2 months time, and historically gold hasn't done very well ahead of the first hike. So it could be likely that this rebound here will be short-lived. It has a technical ground, but fundamentally I would say it's dubious if it's enough for a rally. So historically, gold and silver, these metals started to do well when the tightening cycle was quite mature, and markets already started expecting a reversal in it. So this would be my expectation this time around as well. However, at the same time, when you look at the relationships, you will see that the relationship between gold and S&P 500 is very low, close to these lows from all-time lows from dot-com peak from the year 2000, and therefore precious metals definitely serve as diversification in asset in a portfolio, they make sense. So from this perspective, yes. From more speculative perspective, short-term rebound, yes, because the technical move was meaningful. However, I mean, this tightening, I would be cautious to see, if this move could be extended, because, historically it's, like I said, it looks fairly dubious. Okay, ladies and gentlemen, please stay with us, tracking our news section in XTB platform and the mobile platform. And I see you next year. On the 9th of January is the next weekly webinar with me. So meanwhile, let me wish you Merry Christmas, Happy New Year, and hopefully we all see each other next year.